Looking at the US stock market, we get a very different picture from others. China's market is down over 30%. Emerging markets are in a bear market at this time. Banks too. So right now we are waiting for earnings to over-impress, pushing stocks into a higher level. For China, we are waiting for the central bank to come in and bail out the markets much more aggressively than they have been doing over the past few years. So what is the fate of the markets going into 2019? Well, you came here for the truth, so let me unveil that for you. Today we are going to look at what's going on with the US stock markets, China stock markets, LIBOR, interest rates, so much to cover. Let's begin by taking a look at this article out of CNBC. Dow drops more than 350 points in another bad day for struggling stock market. I've been covering this rout that we have experienced in the short term. I've been paying close attention to what is happening over the past few years to the markets, showing and tracking the progress here on this channel. Right now, you can see that the market is struggling and it's worried about interest rates. I think that interest rates are absolutely critical and they will be the linchpin for any future crisis because they have been so low for so long and the market is used to that, like a drug addict used to getting that flow, that injection, and it needs more and more. It needs the drip. But if it's not getting that drip, well then it's going to be in big trouble. And that's what we're experiencing right now. The only saving grace is the potential for really good earnings to come out of these FANG stocks. If they're able to overperform, then that means that other stocks will benefit from these, okay? Even if their particular stocks are not doing so well because of their earnings, well then suddenly they're going to turn around because there's the buying of the dip action, okay? So the FANG stocks will lead the charge, other stocks will follow suit, and the market can go higher. That's if they over-impress. We'll see. They're expected to do so, so we're going to see how that all comes out. I want to take a look at the NASDAQ composite because you're seeing at the time of this recording in the middle of the day, it's down about 1.5%. So when you look at this market here, this is one that has done so well beyond the other stock markets. We look at even within the US, the NASDAQ has really performed much better. But still, when you go down even deeper and analyze just the FANG stocks, then you see where the growth from the NASDAQ has come from. It's not just the NASDAQ and everything in the NASDAQ doing well. In fact, it comes from just a handful of stocks. But compared to other markets, the NASDAQ is certainly doing a lot better. Again, because of a few stocks. So looking at this, I have to wonder and worry about what's going to happen should the FANG stocks start to decrease and decline. I believe that the other stocks will follow along with it. Chinese stock markets hit fresh 4-year low to lead Asian region lower. It's not just China, but you can look at emerging markets, you can look at other areas around the world, and they have done very poorly right now. They are all relying on the US market to do better, but at the same time, there can't be any fear of spillover and turmoil into these other countries, and that's exactly what's happening with China today. You see that their stock market is down a fresh 4-year low going on. There's tensions that they're worried about right now in the markets. They're worried about so many different things, and this should be a worry of the US markets as well, but apparently that's really not the case. They're shrugging that off, and it's more of interest rates that are becoming the talk of the town. Now we're looking at the Shanghai Composite Index being in one day, previous trading session, down 3%. This shows us that they are very worried and concerned because these markets have been absolutely punished. And I'm going to show you how far this has come in just this year alone. So we could see what it has done in the short term. We look at the Shenzhen Composite Index down 2.73% in this previous trading session as well. This is basically the equivalent of like the Chinese NASDAQ. So you'll look at this and have to understand that it's not just one market, it is more than one market that is suffering today. But if I look at the Shanghai Composite specifically, I use this calculator to be able to show you that it is down 31% from its peak. 31% from its peak that was experienced in January of 2018. So we are by far in a bear market here at this time. We should look at this and start to wonder, okay, we're talking about one of the biggest economies in the world. They're the biggest consumer of so many different things that other countries are exporting. So if China's not doing well, what does that mean for other countries who might need to export oil to China, who might need to export different types of industrial commodities, copper and other things into China, maybe vehicles into China, maybe luxury goods into China, maybe food into China. These things are provided by other countries that which China can't manufacture and consume on its own. It has to get from the outside. But if the outside world is realizing that they can't do so because China is weakening at this time, they're going to suffer. That's going to spread and spread and spread. And then it has to make it back its way back into the US, because the US is importing and exporting from these countries. And suddenly, if their US dollar is too strong, if they're having tensions in between certain countries, we're going to have things thrown up in the air onto the floor, and who knows what's going to happen here. Now, looking at this world's worst, China's stocks have lost about 30% since their January high. It is not just China that's suffering. You can see the 30% drop that has been experienced throughout 2018 alone. 30%. So when we're looking at 20%, we're looking at bear market. When we go into 30%, you got to call that a crash. I keep hearing this silliness that it's not a crash, but what is it then? Is it a correction? It's been going on all year. We're 30%, over 30% down right now at this time. Is that a crash? No, that's not a crash apparently. I don't know. Call it whatever the hell you want. Now, looking at this black line, by the way, which is the Shanghai Composite, you can see this orange line, which has made its way down to nearly 10%. And what we're looking at here is the MSCI All Country World Index, which in this case does include the US. So when we factor in the US, we are still down minus 10% nearly globally. That should be worrisome. That should be a cause for concern because of everybody looking at the markets and telling themselves, okay, because they put a lot of money into these markets, that the stock market is up. I don't know what market you're looking at, but if we look at China, if we look at all countries, we are seeing in both these two cases that the market is down. If you tell me FANG stocks, that's fine, but don't say the market is up. Don't say the stock market is up. Don't. Look at this. Now, everything that's been happening with the Fed, as well as the president, you can see that they have been going back and forth, saying they're too, tightening too much. This is unbelievable. I can't believe this is happening. But I'll let them do what they think is best for now, as if they have any control. This is what Greenspan said. The best thing that you can do if you're the Fed is just put your earmuffs on and just don't listen. I was at the Fed for 18 and a half years. I got innumerable notes, pledges, requests, etc. to lower rates. I do not recall a single instance where somebody in the political realm said we need to raise rates, they're too low. Of course they want low rates, but that's not the way it works. The Federal Reserve acts independently. They will never, ever be shut down, and if they do, you have a very, very big reason to be concerned because something much worse will be replacing it. The Federal Reserve will not go away in the foreseeable future, and like I said, if something's replacing it, it's definitely worse. The Fed is the central bank of central banks, and not in the same way as the biz, but we're looking at this because they bailed out basically everything. I mean, they bailed out Canada in the financial crisis. Why wouldn't the Bank of Canada bail out Canadian institutions? Doesn't make any sense, but that's the way it happens. That's the way it goes. The Federal Reserve was set up in secrecy at a meeting on Jekyll Island. Everybody knows about this by now. They did this in a way that was quite interesting if you read the full story, but essentially what we have today is a market that is relying 100% on the Federal Reserve. The Federal Reserve decides if the sun comes up in the morning. A lot of people don't agree with that, but you just need to do a little bit more reading and you'll figure it all out. Now, this is the LIBOR rate, which some say will be replaced in the future. As of right now, there are well over $300 trillion of financial, quote unquote, instruments that trade using the LIBOR rate. So in the foreseeable future, this will be the go-to LIBOR. So until then, LIBOR is the sort of the king in this regard, but it's continued to increase. So it was kind of stagnating there for a couple months, but now it has increased yet again, and we're going to see this go up, I'm sure, as the Fed increases their interest rates, as other central banks do so. Here you could see what happened throughout the mid-2000s. Rates just continuously increased until they got about 5% or so, then they tapered off. But I just wanted to show you this part in here. If you could see this, there is this very, very quick spike. So in a matter of, it's hard to tell on here, maybe a month or two or something like this, the interest rates on the LIBOR went from maybe 2.5 to 3, somewhere around there, to 5. So it practically doubled in a matter of a month or two. So don't think that it can't do the same this time around. Watch the LIBOR rate, watch the Fed funds rate, and no matter where you are around the world, watch your central bank's interest rates and keep an eye on what they're saying. They will tell you probably beforehand, because they like to shock the market, see how it reacts just by using words, what the Fed calls forward guidance. They use that and then they test the market. They test it to see how it's going to behave, to see what the analysts do, and the market starts to price that in so they can take advantage of it. They know that. All right, so that's all for this video. If you found it informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel, so I do appreciate that very much. And last but not least, if you want the financial education you were not taught in school, well then, these two books have it all. You can get this actually at Amazon. There's a link in the description of this video. If you're more interested in the audiobook version, you can get that at themoneygps.com.